Chapter 1, Introduction to Accounting and Business. Okay, in the last presentation we looked at the nature of business, what the role of accounting was, and then we talked a little bit about the development of accounting principles. Now we're going to start out with what we call the balance sheet equation, define the elements of the equation, and then show transactions within there to show how they affect the equation. And what we've got, the equation is actually assets are equal to liabilities plus owner's equity. And it sounds really straightforward, but be careful, all right? Make sure you practice some problems in this because it can really give you issues. Now, assets are the resources owned by the business. Liabilities are what we owe creditors. And owner's equity is called a residual interest, but it's what the investors have in the company, all right, sort of their stake in the company. And the two things should equal. So for everything that we own, we either, really own it, like it's part of our equity, maybe it's part of our initial investment in the company, or we still owe money on it. And here's another example of the equation, just assets equals liabilities plus owner's equity. Okay, resources owned. The rights of creditors are the debts of the business, liabilities, and equity is the right of the owner. And think of it again as a residual interest. Now here's an example. This John Jews is the owner and operator of Eurostar Motivational Consulting. At the end of the period, 12/31, he had assets of $800,000, liabilities of $350,000. And the first thing you want you to do is figure out what owner's equity is at 12/31/18, and then assume that assets increase by $130 and liabilities decrease by $25. All right, now there's a way I'd want you to do this. Here's I like this better than the way they do it in the book, but here's my first thing that I know is that my assets are $800,000, liabilities were $350, so owner's equity would equal 800 minus the 350 or 450. Okay, again, assets increase by 130 and liabilities decrease by 25. So we'll get new balances now. Liabilities plus equity has to equal 930. So owner's equity would have been 605 at 12/31/09. Now, business transactions, they are economic events or conditions that directly change an entity's financial condition or its result of operations. Okay, it's a transaction. It affects the accounting equation. And here's an example. This Chris Clark deposited $25 in a bank account. So we're going to have assets. We're leaving out the liabilities because there aren't any, okay? Just assets equals to equity, cash increased, and the capital account increased. And just a thought about these account names, memorize them. I'll probably only say that twice in the whole course, but the sooner you know the account names and where they belong, the easier everything else will be. And if you're stumbling over them on the exam, you'll be in trouble. November 5th, the company paid $20,000 for the purchase of land. So $20,000 comes out of cash, and $20,000 goes into land. My total assets are still $25,000. My equity is still $25,000, and the equation's in balance. Now on November 10th, Net Solutions purchased supplies for $1350 and agreed to pay the supplier in the near future, so that would be an account payable. So now for assets, we've got cash. We just bought supplies for $350, so that increased supplies in land. And then our liabilities also increased by $350. So you can see the transaction equals the transaction alone. $1350 equals $1350, and my total assets of $26,350 equals total liabilities and equity of $26,350. Okay, and that liability is an account payable. And the supply will be used in the future, so one way to think of this is a prepaid expense. So it's an asset, it's an economic resource until it's used up. Now, businesses earn money by selling goods or services, and that amount is called a revenue. So revenue would be like sales, all right? That's income. So in this case, we're going to take fees earned and put it over here in owner's equity, all right? Because owner's equity really takes net income in. So net income is comprised of revenue and expense, all right? So we're going to put our revenue and expenses in owner's equity right now. So they received cash of $7,500 for providing services to customers. Cash increased by $7,500 and equity increased by $7,500. My total assets still equal my total liabilities plus equity. Now, revenue from providing services is recorded as fees earned, and revenue from the sale of merchandise is recorded as sales. Okay? And other examples of revenue might be rent, which would be rent revenue. Interest would be interest revenue. Now, those are different than an account receivable, which is a claim against a customer, which is an asset. An account receivable would be an asset right in here. Okay, it's a promise to pay. So during the month, Net Solutions spent cash or used up other assets and earning revenue, and these in the process of, and these are called expenses. So now they're going to pay the following expenses. They've got wages of $21.25, rent of $8,000, utilities $450, and then miscellaneous $275. So these are all, you can see all the expenses that are in here as minuses. All right, because think of this whole thing as like an expanded net income. So this would be revenue minus all these expenses. So I've got cash decreased by $36.50, and this is what I spent it on. My total assets still equals my total liabilities plus shareholders' equity. Now Net Solutions paid creditors on account. Cash goes down by $950, and in accounts payable we reduce what we owe. Okay, so you don't want to think of this as like a negative number. This is a subtraction from what we owe. And our total assets still equals our total liabilities plus owner's equity. On November 30th, Chris Clark determined that the cost of supplies on hand at the end of the month was $550. All right, so they went out and they went to the supply room and they took an inventory and they came up with a number of $550. So if the ending balance is $550, then they must have used up $800. All right, so I'm going to reduce supplies the asset, and I'm going to increase supplies the expense by $800. Now on November 30th, they withdrew $2,000 for personal use, so I'm going to take $2,000 in cash out of cash, and I'm going to reduce increase his drawing account by $2,000. Now that drawing account is a negative number, so that's why it appears like a negative $2,000. Okay, it subtracts from the total owner's equity. And here's a summary of all of our transactions. You've got some problems. I think you've got a homework problem like this where we've got all of our accounts across the top, and then you record the transactions in here and take balances in your major accounts each time, okay, and making sure that your total assets equals your total liabilities plus owner's equity. Okay, and here's a sort of a nice illustration of what's happening in owner's equity. We're going to increase it for owner's investments. That's actually a capital account. We're going to decrease owner's equity when the owner takes money out of the business. That's actually a withdrawal account. And then we've got revenue minus expenses. So here's an example that the Salvo company is owned and operated, whatever. Received cash from owner, $35,000. Paid creditors, billed customers, received cash, paid cash. Now, one thing I want you to notice is see how it says received cash here. Okay, let's highlight that. So let's put a pretty color. That's too dark. received cash, okay? Paid creditors. Billed customers, received cash. Paid cash. So in every one of those transactions, cash is being affected, right? We've received cash or we paid cash. Billing customers might still be a transaction that we'll recognize, okay, because the earnings process is complete, we've done the job, but it would not be, it's not a cash transaction. So now we want to know this, for each transaction, talk about what accounts were affected by this. And here's the answer. These are kind of small, huh? Well, that didn't help a bit. So cash is decreased by $1,800. The payable decreases by $1,800. That's when we paid the bill. Here we billed a customer, so accounts receivable increased by $11,250. Revenue delivery service increased by $11,250. Sorry about this. What was the next one though? Oh, someone paid on account, so the asset cash increased, and the asset accounts receivable decreased. And then finally, the owner took $1,000 out of the bank, cash decreases, and the drawing account increases, and that drawing account is a negative account. Okay, so make sure that you listen to the problems on this and then do the written problem. Okay.